Welcome to the 10th session of my course Financial Accounting 101. In this session, we are going to learn something more about the cash flow statements, which form an integral part of the financial statements as per section 240 of the Companies Act 2013. So let us move ahead. So these were the three questions which we are trying to get the answer from. So question number 1, that is what do I own and what do I owe, is being shown from the balance sheet. Question number 2, how much money have I made, comes from the profit and loss account. And the answer to the question, how much cash has came in, how much cash has gone out, will be getting it from the cash flow statement. Now, as said earlier also, it depends upon so many factors, whether you have to follow the AS accounting standard or the Ind AS. So the specific standards for cash flow statement is AS 3, or if you are following Ind AS, it will be Ind AS 7. Please remember that this is a statement which has to be compulsorily made only when you are a company under the Companies Act 2013. So if you are an entity like a partnership firm or a proprietary firm, or you are working as an HUF entity, then this statement probably will not form a part of your final accounts. This statement assesses the ability of the enterprise to generate cash and cash equivalents and the timing and certainty of that generation. That is, how much amount of cash and cash equivalents are you going to generate at what point of time? This answer would be given by the statement known as the CFS. It also assesses the needs of the enterprise to utilize the cash and cash equivalents generated. The cash flow statement, when used in conjunction with the other financial statements, provides the information that enables us to understand the changes in the net assets of the company, the change in the financial structure of the company. It also shows you the liquidity and the solvency risk. So what is liquidity risk? It is the risk, or it is that how much strong the company is so as to pay the short-term liabilities. What is solvency? The ability of the company to meet the long-term liabilities. And the CFS also helps us to evaluate the ability of the firm to affect the amounts and the timing of cash flows in order to adapt the changing the circumstances and the opportunities. Now, cash flow information is very useful in understanding the ability of the enterprise to generate cash, and it enables us to form models of valuations as we go ahead, because valuation models depends upon cash flows and not just profits. So there are certain definitions. First is, what is cash? Cash is comprised of cash in hand and demand deposits with the bank. So we have two deposits, demand deposits and term or the time deposits. For demand deposits, they are not time barred. 1 साल का या 2 साल का. You can put it and you can remove it, at a point. It's like a savings account. You will not ask the bank कि पैसा उठाऊं या नहीं उठाऊं. Whereas what is a term deposit? They are those deposits where it is time bound. आपने FD किया 1 साल का, 1.5 साल का, 2 साल का. All this will come as term deposits. So what is cash for us? It's cash in hand and demand deposits with the bank. What are cash equivalents? They are short-term but highly liquid investments that can be readily converted into cash, known amounts of cash, and which are subject to an insignificant risk of change in the value. One of those investments that are very liquid, mostly it's less than 3 months, which you know that you will be exactly getting how much amount, and there is no significant risk of change in value. If you invest in a share of Reliance, no doubt it is liquid. Paisa on the spot aa jayega, but you never know what amount you will get, because the amount you will get will depend on the market. So such things are, even though they are liquid, but they are not cash equivalents. Cash flows are of two types, as we know. It can be inflow of cash, paisa andar aana, and outflow of cash, paisa bahar jana. Then the whole cash inflow and outflow has been divided in 3 different categories. So you can get cash flow from operations of business, you can get cash flow from investing activities of business, and you can get cash flows from the financing activity of business. So let us understand the first part, operating activities. So in this case, they are those activities that are principal revenue producing activities of the enterprise and other activities that are not investing or financing activities. Now you can see this type of definition, we call it the inclusive and exclusive definition in terms of law. जहाँ पे ये बोला है ये क्या है और ये बोला ये क्या नहीं है. So over here, any activity that is principal revenue generating, मतलब जो actual business करके हम कमा रहे हैं या वहाँ business करने में वो पैसा लग रहा है, will be a part of your operating activities. And any activity which cannot be clubbed under either investing or financing will be again clubbed back to the operating activities. What are investing activities? They are those activities which are which are related to the acquisition and disposal of long-term assets and other investments, not including the cash equivalent. When you buy or sell a long-term asset, it is known as a investing activity. What are financing activities? They are those activities that result in the changes the size and composition of owner's capital, including preference shares and borrowings of the enterprise. So whenever there is movement in the long-term funds, either equity or debt, it will be clubbed as financing activity. So as I told you, what is cash equivalent? They are held for meeting the short-term commitments of the company. It is readily converted into known amounts of cash. There's very insignificant risk of reduction in value. They are in short-term maturity, less than 3 months mostly. As per Ind AS 7, even bank OD is a part of your cash equivalent. However, the cash credit that you get from the bank is not included in the cash equivalents. Movements between cash and cash equivalent. आपके पास cash था, आपने invest किया in the cash equivalent, and you had cash equivalent और आपने बेच के you converted cash. Now this movement in between C and C doesn't form a part of your cash flow statement. So let us understand cash flow from operations in detail. As said, what is cash operating activity? They are the principal revenue producing activities of the enterprise and other activities which are not investing or financing activities. So the amount of cash flow arising from operating activity is a key indicator of the extent to which the operations of the enterprise have generated sufficient amount of cash so as to maintain the operating capability of the enterprise, so as to pay the dividends, so as to repay the loans, and so as to make new investments without recourse to the external sources of financing. So the more operating cash flows you have, it means what? You're going to use this for your day-to-day operations. That cash will be used to pay the dividends to the shareholders. That has to be used to be paid to the repay the loans, and also it should be such that you should be able to grow your company without getting too much dependent on the external sources of financing. Information about specific components of historical operating cash flow is useful in conjunction with other information in forecasting future operating cash flows. What are the examples over here? Is cash receipts from sale of goods, cash receipts from the royalties, fees, commissions, and other revenues. Actually, जो धंधा करके हम कमा रहे हैं वो, and the amount that you pay for suppliers of goods and services, cash payment on behalf of employees. So it is basically all the inflows from business and all the outflows from business for business. Operating activities can be broadly covered in 2 sections. Now, as we said that the full cash flow can be classified in 3 sections. It is cash flow from operations, cash flow from investing, and cash flow from financing. Right now, we are trying to bifurcate cash flow from operations in 2 parts. First is the cash flow from operations before working capital changes. That is, how much do operating profits contribute to funds generated by the company, and cash flow from operations after working capital changes. That is, how much does the working capital drain away from these profits, or conversely add to such profit generation. So if a company suppose generates 80 rupees through operating activities and plowbacks 40 rupees in working capital, that is unlikely to be cash rich in spite of being profitable. This is for sure. Please remember, the cash flow from operations could be found in 2 ways. One is the direct method, one is the indirect method. What is direct method? You actually find कि धंधा करके मतलब debtor से कितना पैसा दिया, how much have you realized from the sales minus how much you have paid to the suppliers and all these things. Either you do it that way or you do the indirect way, when you write the profits before tax and then you adjust it to get what is the cash flow from operations. All the companies follow the indirect method of generating cash flow from operations. So this is the cash flow from operations of Reliance Industries Limited. So you can see over here that you start from net profit before tax. Then there are so many adjustments made over here, this part. Then you get the operating profit before working capital changes. How much money have you generated by doing business before you have invested the same amount in your working capital requirements. Then you adjust for the working capital. So you get the cash generated from the operations. Minus you do the tax paid, you get the net cash flow from operations. That means how much amount have you generated by doing pure business after you had invested in your working capital. So what is the adjustments for? You will add back all the non-cash and non-operating expenses. Like over here, you can see there is depreciation, 29,797 crores. Now, this profit that we have got on the top, 84,142 crores, has been arrived after reducing depreciation. However, Depreciation is just an entry. There is no cash inflow or outflow. So what do? You will add it back. Okay. And then we have over here, so यहाँ पे we also have, sorry, we have dividend income 41. Now this is a non-operating income. मतलब ये वो पैसा नहीं जो हम धंधा करके कमाए. But this is a part of your profit before tax. You want to find how much profits or how much cash flows you generate from operations. So what I'll do, I will reduce this dividend income from my profit before tax. Similarly, I've also reduced the interest income. So what is the basic crux of these adjustments? You will add back all the non-cash and non-operating expenses, and you will less the non-operating incomes. Okay. Then comes, so over here you can see that the Reliance Industries Limited had made 29,584 crores of cash flows before adjusting for working capital. Sorry, they had made cash flow of 1,13,726 crores before adjusting it for working capital. As compared to last year, they had made 80,129 crores before adjusting for working capital. Now, after this, you adjust for working capital. So what you essentially do is that you add the cash inflows by way of decrease in current asset. Why? Because जैसे आपका suppose stocks, debtors suppose नीचे गया, when debtors will go down when you receive cash, so cash inflow हो गया. So you will add back the cash inflows and you will less the cash outflows. So what is cash inflow? Either it is decrease in current asset or increase in current liability. So when the suppose creditors go up, what does it mean? I have saved huge amount of cash outflow. Mera cash, because they are the sources who are funding my working capital. So that is added back. And what is less is the cash outflow. So when you say there is increase in current asset, suppose stock बढ़ गया, stock कैसे बढ़ेगा? When the cash has gone out. And then you say decrease in current liability. Now why is it cash flow? Because जैसे suppose creditors कम हुआ, मतलब you have paid them, तो cash हार गया. So after operating profits before WC changes, you are going to do adjustments for working capital and find out how much amount have you generated from the operations after investing back in the working capital. So in this case, the operating profit before WC changes was 1,13,726 crores, which after adjusting became 1,14,451 crores in this year, whereas last year it was 30,000 crores. And then you adjusted for tax paid. So how much amount you generated from operations and operations only? 1,10,654 crores. Now this is a growth of 3x. So what Reliance is essentially done is that Reliance in the year 21-22 as compared to the year 2021 was able to generate a huge amount of cash flows from operations after adjusting for working capital, which is a very good sign. So this is again the whole thing in one shot. Now we come to cash flow from investments. So the activities of acquiring or selling off of long-term assets and other investments, except that in cash equivalent, will be a part of your investment activities. It includes making and collecting of loans. मतलब आपने loan दिया, loan लिया. You had acquired or disposal of debt and equity instruments. So you bought certain shares of a company, you sold certain shares of the company, you bought a property, you bought fixes. All this will be a part of your investment activities. Okay. Examples में क्या होगा? Cash payment to acquire fixed assets, cash receipts from the disposal of fixed assets, cash payment to acquire shares, warrants, or debt instruments of other companies, and the interest in joint ventures, cash receipts from the disposal of the above assets. So these are part of your cash flow statements classified as investment activities. So in this case, you can find for Reliance that they had done expenditure in the PP&D and other intangibles of 1 lakh crores, and then they had invested in the last year they had invested 1,05,000 crores. Okay, this was the amount that they had invested in the long-term assets known as PP&D. Now they had also sold certain part of the long-term assets over here, like they had sold certain part of PP&D of around 3,137 crores, and last year also they had sold some part. What is critical in this part in Reliance? That is purchase of other investments. You can see that they have invested around 6,67,878 crores in other investments. However, they had also sold other investments. So, jo paisa aaya, which you had invested outside your business somewhere, not exactly in the operations, has again be plowed back in the investment somewhere else. So at the end, if you see the net cash flows used in investing, यहाँ पे ये negative है, मतलब cash बाहर गया है. So that means that how much has the cash gone out in investing activities? 1,10,103 crores, which last year was 1,42,409 crores. So this much amount has been invested in the long-term assets. It can be PP&D or it can be other long-term assets, including investments. Now the last is the financing activities. Now those activities that result in the change in the size and composition of owner's capital and borrowing organization will be classified as financing activities. The separate disclosure of CFS or cash flows arising from financing activity is important because it is useful in predicting the claims on future cash flows by the providers of funds, both the equity guys and the lenders. Okay. It includes receipts from issuing shares. So when you issue shares, debentures, preference shares, you get the money. Whereas when you repay all of them, either you repay a loan or you repay a debenture or you repay or you buy back a share. All this will be a part of your outflows of funds, which will be classified from the financing activities. So let us see this. Reliance. So we have cash flow from financing activities, proceeds from issue of equity capital, 5 crores. You have issued some new shares. Now proceeds from the issue of share capital to non-controlling interest. So what is this? These are those investments that you have made somewhere, where in your subsidiary companies where you have sold the shares to those guys who are having non-controlling interest, and there is a less than 50% interest in the things in that company. So this is that amount. You can see that last year they had raised around 2 lakh crores by selling this type of shares, wherein this time it is 450 crores. Then we have net present rights issue. So Reliance had came with a rights issue. What is rights issue? The current shareholders of the company get a right to buy the new shares at a probably discounted value as compared to the market price. So last year they had done it of 13,210 crores, and this year it is 39,762 crores. Then we have payment of, so you can see proceeds from the borrowings. So what is this? You have raised new funds from borrowings, and what is this below it is repayment of borrowings. So that is negative. That means utna paisa aapne de diya. So at the end, if you see net cash from financing activities, this year was 17,289 crores, whereas last year it was 1,01,904 crores. What does it mean? Reduction in the influx of new outside capital by almost 83%. You can understand that because it's a long-term funds that you have already taken. Now you can see over here we have dividend paid. Dividend paid will be classified in the financing activity because the dividends are paid as you had raised the funds in form of shares. Okay. Similarly for interest. Interest भी आपने क्यों financing activity में डाला है? Because they are those things which you have paid for the long-term bonds that you have made. So after these three things, you will say what is the net increase or decrease in cash and cash equivalent. What does it mean? It means after you add cash flow from operations, cash flow from investing, and cash flow from financing, it can be positive or negative. You know, okay, is sal, what is the net increase or decrease in cash? So last year it was decrease in cash by 13,547 crores. This time it is an increase in cash by 70,840 crores, which leads to a growth of CNCE by 108%, which shows that company has become more liquid as compared to last time. Now this, the amount that you see 36,100 crores, the same amount that you see in the balance sheet. So this is just an overview of the whole thing. Now there are certain specified items like interest. When you receive interest, interest received from investments will be classified from investing activities. So when you have made investments of long term in nature, whatever interest you get will be a part of your cash inflow classified as from investing activities. Cash received from short term investments classified as cash equivalent should be considered as cash inflow from operating activities. If you have invested in any deposit which is less than 3 months, which is a demand deposit, which less than 3 months, which is classified as CE, उसमें जो आपने ब्याज कमाया, that interest will be a part of your operating activities. It will not go to your investment activities. And the interest that you receive on trade advances and operating receivables should be in operating. If you are charging some interest for a person not paying you on time, तो वो जो interest है कहाँ पे आएगा? It will be a part of your operating activities. It will not be classified as to investment activities. Now interest paid on the loans and debts that you pay on long term loans, it will be part of your financing activity. However, the interest that we have paid on the working capital loans should be classified under cash outflow and operations. However, I have seen most of the companies they put up where in financing activities only. But basically it has to go where in the operations. So any interest paid on long-term loans will be a part of your financing activities, and any interest paid on working capital financing will be a part of your operating activities. So cash flow from interest should be separately disclosed. It's very important to disclose itna interest gaya, you cannot net it off. The total amount of interest paid during the period is disclosed in the statement of cash flows, whether it has been recognized as an expense in P&L or capitalized in accordance with India's 23 borrowing cost. Now, as we had done in that profit and loss account, if you remember, that Reliance had actually they had they had capitalized around 10,000 some odd crores of interest to the balance sheet. मतलब उन्होंने क्या किया था? They had not shown that interest in P&L. Instead, they had shown that interest. They had added it back to the cost of the asset. So यहाँ पे in cash flow में क्या होगा? You have to show total interest paid, whether you have shown it is in P&L or in you have capitalized in balance sheet is immaterial. So I always say that's the reason why cash flow is a statement which will say the least amount of lies as compared to the P&L and the balance sheet. Now we also have the treatment for dividends. So when you are a financial enterprise and you receive dividends, मतलब आप NBFC हो, you are a bank, and when you receive certain dividends, this will be classified as operating activities because the business of a financial enterprise is to invest and make money. Okay. However, the dividend received by any other enterprises which are not financial enterprises will be a part of your investing activities only. Dividend paid, whether you are financial enterprise or whether you are a non-financial enterprise, the dividend paid would be classified always into financing activities. Why? Because you are paying dividend as you had raised funds, and that funds raised will be a part of your financing activity. Cash flow, again, cash flow from dividend should be classified separately. Then we have specific items tax. So cash flow from tax payment refunds should be classified as cash flow from operations. So it can be income tax or GST. However, if the cash flow can be specifically identified as a cash flow from investment or financing activities, appropriate classification should be made. For example, suppose you are paying capital gains tax on a selling of an Apple asset. So this will be a part of your what? This will be a part of your investing activities. Why? Because you are paying this tax because you had undertaken certain investments. It is not classified as cash flow from operations. So mostly income tax and GST. So all the taxes which are related to the normal day-to-day business operations will be a part of your cash flow from operations. Now, investment made in subsidiaries, as well as joint ventures. Only cash flow between itself and investing company is required to be reported. मतलब Reliance ने जो पैसा subsidiary associate में डाला है, the movement between Reliance and the subsidiary यही होगा. Subsidiary के अंदर का यहाँ पे हम report करने वाले नहीं है. Example: cash flow relating to dividends and advances will be a part of your cash flow statements for Reliance Industries Limited consolidated. Then you can also acquisition and disposal of subsidiaries and other business units. So cash flow on acquiring and disposal of subsidiaries should be presented separately, and it has to be classified as investing activities only. And entities are disclosed in aggregate in respect of both obtaining and losing control of subsidiaries or other businesses during the period. Like what I'm going to say, what I'm going to report, the total consideration paid if you have bought the subsidiary, and total consideration received if you have sold it. The portion of the subsidiary, of the consideration consisting of cash and cash equivalent, the amount of cash and cash equivalent subsidiaries and other businesses over which control is obtained or lost, and the amount of assets and liabilities other than C and C in the subsidiaries or businesses over which control is obtained or lost, summarized by major category. Then what are non-cash transactions? This should be excluded from the cash flow statement. This transaction should be disclosed in the financial statements. So example, acquiring of an assets by assuming a direct liability. मतलब एक somebody was having a land, उस पे एक लोन चला रहा, आपने क्या बोला भाई ये लैंड मैं ले रहा हूँ, I'll not pay you anything, instead I'll pay the home loan, तो निकल जा. So when you directly assume an asset with the liability, it will not be shown in the cash statement. Acquisition of an enterprise, you are buying a company by selling your own shares, मतलब there is no movement of cash neutral transaction. This is again not form a part of your cash flow statement. And conversion of debt to equity, मतलब आज वो loan था, but you said what now this debt has become an equity. Again, since there is no movement of cash from company to somewhere else or from somewhere else to the company, it will be a part of your non-cash transactions. It will not be reported in the CFS. Disclosure of C and C में क्या आएगा? Components of cash and cash equivalent क्या क्या उसके अंदर है? You reconcile the amount No, and it has to be equivalent. The cash, the CNC as per cash flow statement should be exactly the same as per in the balance sheets. So this there will be huge amount of disclosure for CNC, which you will find the cash flow statements. These are certain distinguishing factors between AS, Ind AS 7 and AS 3, which we are not going in detail in this video right now. I hope you remember this triangle. This part, like depreciation, is a major role in balance sheet, CFS, and statement of profit and loss. So the whole point is what? Remember that accounting or accounting statements could not be read in silo. It has to be read as a total aggregate of all the statements. Thank you. I hope in this video you might have learned something more about the cash flow statements. Thank you so much.